Okay, today's topic is reading 13, which is concentrated single asset positions. This is a new reading that has just been included for the 2014 level 3 exam. And interestingly, this takes off or is a new reading derived from the previous reading, which was called low basis stock. So reading 13 previously was low basis stock. It is now called concentrated single asset positions. Now in terms of LOS, there has been significant enhancement. So where there were about 5 or 6 LOS in the last reading 13, this time there are 12. And also, this topic has a lot of depth. So the way I see it is that it's a new topic, there are new LOS, so there's a high chance that this could show up on the exam. Previously, low basis stock used to form a small part of a question. Now that this is a bigger reading, there could be an opportunity for the examiner to test an entire question based on this particular reading. Okay? Let me go through the contents of this chapter. We'll start with the introduction. Essentially, this talks about how people accumulate concentrated holdings. They can be accumulated through a variety of means. Firstly, an executive can work in a company and obtain stock options and eventually, over a 30-year, 20-year period, hold a substantial amount of equity of the same company that he works for. That's one opportunity, one option, or one instance whereby we accumulate concentrated holdings. The other is when we have an entrepreneur who starts off a business from scratch, and then that business grows and becomes a bigger company, and that's also another instance of concentrated holdings. So what we'll do is there are 6 sections in this reading and we'll go through them one by one. So to kick off, let's first look at, obviously we'll be following the curriculum. So let's first look at a very interesting graph here that shows that people, what is the percentage of wealth that is derived from small businesses, for private clients. So in the UK, you have to look at 76% clients actually derive their wealth or most of their wealth through their businesses. So the final point is that there is a high percentage of concentrated holdings for clients across the globe. In case you're wondering what Pacific Rim is, Pacific Rim comprises of countries in North Asia, which could include South Korea, China, Japan, also the Oceania countries, including Australia, and there are some other islands in this as well. So and as you can see, the more we drift from emerging markets, well, it's not exactly an emerging markets to developed markets graph, but if you look at this, if you take this as an emerging market sample, then it's the highest number of people that are actually generating their wealth through business means. Okay. The other thing is, which is very important, that concentrated holdings by default or from the perspective of this reading are illiquid. So technically we're looking at situations whereby clients will want to either sell or monetize their assets to generate cash. Okay? And obviously, as we have discussed in reading 11, and reading 12, that taxation is an integral part of portfolio management. This applies very clearly and which is very important from a perspective of concentrated holdings, since in the event that there is low basis for a stock and then you sell it 30 years from now, there's a huge amount of capital gains that will have a tax event. So you would want to also take a look at the tax framework. All right, now let's discuss the basics. So first of all, the important point to make is that this is a significant portion of your net worth, concentrated holding, even if it is not a significant portion of net worth for an individual. So for example, an investor has a very well diversified portfolio of equity and fixed income. Okay, so from a net worth angle, it could be a small portion, but it could form a substantial portion of your equity portfolio. So for example, you have one block which could amount to 75% of your equity portfolio, but that is concentrated holdings. So in terms of heuristics and in terms of generalizations, we could say that 25% of a portfolio, if you have one holding that constitutes 25% of your portfolio, you can safely classify it as a concentrated holding. Okay, the only word of caution is that don't bank on this 25%, look at the case in the exam. Okay, so one country could have a law for concentrated holding which could be 15%. So that's, I think, is important. Okay, like I mentioned, it could be a small portion of the net worth, but they can form substantial portion of equity holdings, thereby leading to an undiversified portfolio. So that's really the problem, isn't it? That a concentrated holding will lead to an undiversified portfolio, which means that the variability and variation of returns, the standard deviation of the portfolio will also increase. So this is essentially a challenge for equity managers. And when you look at the further sections of this reading, you will see that equity managers have a host of tools and strategies to address and mitigate certain risks associated with concentrated holdings. Okay, usually what we've seen is that concentrated holdings are accumulated over long term. Hence, there's a huge amount of capital gains that you need to look at. There's a tax incidence that you need to explore, and also there are liquidity considerations. And we are looking at, for the purpose of this reading, we're looking at three kinds of concentrated holdings. The first one is the publicly traded single stock holdings. This could be a significant block of shares in a company that is listed on the stock exchange. So this could be, even a large cap or a small cap. It depends on individual ownership composition. The other category is a privately held business. So privately held businesses, mostly, if you look at them, are family owned. If they are not family owned, they are limited shareholders. Publics are not really shareholders of privately held businesses, hence the concentration. So you could have families, and I have clients whereby they own, between two brothers, they own 80 and 20, the entire 100%. So from one family's perspective, it's a one block of 100% that they own. The third, and again, this is the new addition, is an investment real estate. This is real estate that you've purchased or you own, which actually derives some returns. Or this is something that is integral to your business. So this is not the property where you live in, apparently. Okay? All right. So let's go through the overview of each of these items. Now, publicly traded single stock holdings, while they are public, can suffer from a lot of anomalies. And what we have to actually look at in the exam is that, first, how is this being accumulated? So that's the first question. So you will have two kinds of instances. First is an executive, that an executive joined a company, worked for 30 years, stepped up the plate. During that period, the company had a very good stock option scheme, okay? And with this stock option scheme, this individual kept buying, and in fact, he was encouraged to buy this holding so that they could remain more involved in the company and actually drive the business to grow further so that they could enhance the value of this portfolio. Okay. For some investors, it's also a case of long-term buying of a particular stock and then holding that particular stock. So there's no balancing for that stock. Considering a stock is paying very good dividends, is stable, is a good company, a lot of investors just don't want to sell that stock. Okay. Also, in an IPO, when an initial public offer takes place, there are investors who participate in what we call a private placement or what you call a book build. And in that book building process, qualified investors come in and place their bids through a Dutch auction method, and they could take up to 75% of the IPO size of the offer. So it depends on how this stock has been accumulated. The third event in which you can actually become a shareholder in a publicly traded company and may have a concentrated holding is that if the publicly traded company acquires a private company, and that private company owner, because of a share for share exchange, there is no cash that exchanges. So that private owner can have exposure because of that share for share exchange to a high amount of public shares, and then he might end up having a concentrated holding. So for example, if both companies, the public and the private companies, have the same valuation and the share goes for 1:1, eventually one private shareholder, if it's one shareholder, he could end up owning 50% of the combined entity. Okay, that is concentrated holding. Okay, the other instance, second category, are privately held businesses. These are businesses that are generated through ideas, entrepreneurs who launch these businesses. Classic example are technology companies that are launched and then grow big almost overnight. And you have seen recent listings of these technology companies. You can give the example of Facebook. You can also talk about Twitter, and also talk about LinkedIn, which all of us use here. Okay, and the other focus that you have to also look at, why do people hang on to these holdings, is that if they want to pass it on to the next generation. So there's a bequest perspective that also plays in this instance. The third category is the investment real estate, as we discussed. This is a standalone investment. These are long-term assets. These are assets that you may have held for 30, 40 years, typically held for a long time. And you could also have exposure to real estate when you buy a business. So you bought a business and you valued the business based on the cash flow. But once you bought the business has an inherent real estate, the physical presence of the business. So whereas you may not have wanted to actually buy the real estate, but you have bought it as a result of the acquisition. So that's another instance where you may end up with a real estate exposure. Okay, there are three categories of risks that are associated with concentrated holdings. The first event, and let me put in some examples here. The first event is a systematic risk. Now we all know that systematic risk is the function of the capital asset pricing model. Okay, we are looking at market risk. We're looking at, this is a risk that cannot be diversified away. Okay, so a classic example could be that an executive of a big company owns substantial amount of stock options, and that company is growing. That's great. But in a bear market, what happens in a bear market? The stock goes down. The stock goes down, and with it, there is a loss of earnings for the individual. So that, I think, is the systematic risk angle. But if this was company specific, it would not fall in the systematic risk category. Okay? Now, what is unsystematic risk? We discussed that this was company specific risk. So the curriculum loves the example of Enron. So Enron was trading at about $90, okay, at its peak, and the pension fund or the stock option, the pension fund of this company was, I think, about $2 billion, out of which 1.3 billion was invested by employees. So everybody was a big believer that this was going to change. This was going to change the world, and inevitably Enron's value actually became zero, from $90 to zero. So you can only imagine the amount of loss that people incurred. So that is unsystematic risk. Okay. The third event are property specific risks. We're talking about real estate here. So imagine a situation where there is a new hotel opening up, okay, and then there is a dispute between the parties, and you've bought a portion as a retailer in that property, and now it's not being completed because of that dispute. It's a legal dispute, and this doesn't go on. Second thing, the example could be environmental. This was probably a dump site, and there was not it was not cleared, and the permits were not attained. The real estate was bought, they advertised, you bought it, so that could be a problem. Okay. And the other thing is, so if you own a property and your IPS or your internal standard framework says that this property should only be rented out to investment grade clients. This is a plaza, that is beachfront, expensive property. This is office property. You want to give it to high quality tenants. So in the event that those tenants do not renew the lease for the year, there is a potential there is a loss of earnings. Okay. And what if you want to recoup the losses and you give it to clients who are non-investment grade? Then what happens? You could have a credit event potentially. Okay. Potential credit event. So I think that's the perspective that we need to look at. Okay. This is very interesting. So what we are going to go through here, and I don't want to delve into the quant's angle of this particular graph, since clearly this is given here for a higher purpose, and the purpose is that an individual, or rather an individual, and this is the value of the holding, which is $1 in a single security. They're talking about concentrated holding. This has a zero cost basis, okay, and a 40% volatility, okay, and these are the range of returns and liquidation value. Just look at this, okay, just look at the standard deviation, the risk, okay. Now let's compare this with a situation whereby this individual sold this particular property and incurred a 20% tax. So this was a $1 holding. You sold this holding and you incurred 20% tax rate, and you invested this 80 cents in a diversified portfolio with a 0.8 cost basis and a 17% volatility. What happens to the volatility when you go for diversification? It goes down, okay? And let's look at, now you look at the variability of returns, okay, the liquidation value. So when you look at this particular table here, this tells you one very interesting thing, that while the expected final value of portfolio A versus B, if you only look at the expected value, you could form a decision that portfolio A is my choice, I'd go for it. But look at the probability of value destruction at the end of the day. Look at growth. 39% of $1 or less versus 2% in portfolio B. 57 versus 21. Okay. So we've all figured out that there are diversification benefits. There's a high standard deviation of concentrated holdings. And expected final value should not be looked into as in isolation, also look into the other parameters of this analysis. So again, the curriculum keeps hitting the point that diversification is not an option, it's imperative that one pursues a diversification strategy. So I think also thereby further emphasizing that concentrated holdings have massive risk associated with them. Okay? Now, what are the objectives of clients? So what we're going to do now is, we've discussed that there are concentrated holdings, there are types of concentrated holdings. One is a public holding, one is a private business, third is investment real estate. Okay? Now, the next topic that we're going to go through is essentially what are the objectives in managing concentrated holdings. So what are the objectives when we are looking at, when you see a client as a portfolio manager who has concentrated holdings, what should be the objective in managing it? So the first thing is that you need to reduce the risk of wealth concentration. So there's a client, 80% of his entire portfolio is one company, which is growing, which is making a lot of money. That's fine. But because it's 80%, there is a substantial amount of risk that is associated with this portfolio. It's not an optimum portfolio. It's an undiversified portfolio. The second objective from an IPS perspective is to generate liquidity to satisfy spending needs. So imagine a client who is now retiring, has a significant portfolio of one holding, which amounts to 70% of his portfolio. Now that he's retired, the question is, does he need such a flip-sided portfolio? So at one point in time, even if he was an employee who was mandated or required to hold a large amount of company stock, but now that he's retired, essentially we discussed in estate planning, we discussed longevity, we discussed core capital, we discussed the risk of running out of money to spend. Okay, so I think from a portfolio angle, it also needs to look into current spending needs and also future spending needs. So that I think ties in very clearly with the concentrated holdings, that this could substantially impair your ability to spend or maintain status quo in terms of your lifestyle. The third objective when you have a concentrated holding is to look at taxation. So you want to optimize your tax strategy, tax efficiency of the portfolio, because in the event that you sell this, let's look at an outright sale, and if this developed market has a capital gains tax of 70%, thereby a massive amount of the portfolio gain is just goes away in taxes. So the client loses a lot of value. So there are options. We discussed asset locations. We discussed, should you keep your money in tax deferred accounts or tax exempt accounts? We've discussed 2-3 of these permutations and combinations. We also discussed generation skipping accounts. I think this also ties into concentrated holdings. Okay, so let's look at client objectives pertaining to stock holdings. So why would a client want to keep the stock? So that's the question. Why does he want to keep it? So what we're talking about is not diversifying the risk. What we're talking about is actually retaining the risk. So what are the reasons why this risk is not being diversified away? So the first category, again, you'll look at executives, you'll look at entrepreneurs. The first category is that executives are holding stock to drive growth. So the company encourages executives to hold a large amount of stock. There is a handsome stock option policy. The executives, have this view that if we hold this stock and we are at the end of the day driving the growth of the business, the more stocks we own, the more we'll be and driven to generate more growth for the company. Okay? The other option, the other category is, the other instance is that a business owner is looking to maintain voting control. This could be a classic case of companies who might want to delist. So there are rules that if you own 75% or above in companies, you can take decisions. So essentially, when you have voting control, you can take a lot of decisions. So some owners would want to ensure that they keep a substantial hold of the company so that they don't have any problems in taking decisions. The third objective is that while your objective could be that you are actually getting a good dividend yield from this particular holding, which is concentrated, you actually believe that this stock has just started growing and this stock will grow many folds. So you also want to benefit from long-term capital depreciation. So that's again one of the reasons why a client may decide to keep the stock. Okay? Now, we've discussed public stock holdings. Let's talk about private businesses. Why would people be holding concentrated holdings of private business and shares? The first instance is that this company is not very old. It's too premature to take an exit. This company has just started. Now is not the time to sell this company. Okay? So if Facebook was sold a year and a half before the IPO, the value that you'll derive, or the CEO or the owner of the current company would be very disappointed. Happy for the company, but disappointed from his perspective of his wealth. The other objective for private businesses, and this is inherent for most private businesses, they like to maintain control of the company. We're talking about families, we're talking about old school individuals. Okay? Another perspective on why people actually hold on to these private businesses is that there could be an instance that the owner of the business is actually going to cede control or pass on control of the company to the employees. But there is a lock-in period of 25-30 years, and so he's holding it. And once he retires, the other employees take over. So there are examples, even in fact in technology, where there are employee-controlled companies, where there are a bunch of employees and they're all stockholders. So once somebody retires, then they pass on the ownership to somebody else. So one of the requirements could be that you have to be a current employee to hold stocks. So I think that probably ties in over here. That's the employee angle. And the other opportunity is the ownership to next generation. So this is family to family bequest, passing on the wealth to the other generation. I think we discussed that Warren Buffett is going to pass on just 1% of his entire wealth to his children, right? But if he was passing 100% wealth, things would be very different. Okay? The third category is investment real estate. Now, why would you want to hold on to real estate? Now, in emerging markets, the case is very simple. Sometimes it's undervalued. But the curriculum states that it is an essential part of the business that you run. So the one thing you don't want to do is do anything with the real estate. So real estate globally, is incredibly expensive. So what you don't want to do is tinker with this asset. It's a very essential asset. The other angle is price appreciation, that you expect this real estate to grow. And the third one again is passing on to the next generation. Okay? Now, let's look at considerations that affect concentrated holdings. Now, there are two considerations. I think this is also part of the learning outcome. One is taxation. Taxation is very relative. I mean, if you have a company that started with nothing and now is trading at $100, and now you want to sell it, there is a tax impact. So I think they've kept putting the same point. I think this ties in with the previous reading, but because this is a new reading, they've mentioned it again here. And the other angle is liquidity. If a stock is illiquid, there could be substantial or adverse implications on you, on the client, in terms of his future spending ability. The other, what if he wants to settle the portfolio or get out of it? What if he can't get out of it? What if there are very limited number of buyers for this holding? So that also plays a role. So there's liquidity and there's tax. The other angle could be that there are also constraints. So we discussed that what could be client motives to hold on to these concentrated holdings. Okay, there are these internal perspective, which is why we will not sell or monetize. The other perspective is there is a huge amount of tax on this, so I don't want to exit. It's illiquid, so I can't sell it. The other element is the external element, which is markets related. So a lot of these economies have restrictions on how much can you borrow based on these margin rules. So sometimes you actually can't derive maximum benefit through your portfolio. So I think that is the driving point here. The other angle is securities law. So that could also be a limitation. There could be contractual restrictions. So you could have lock-in periods, and this is prevalent even for private equity, where businesses are invested in and then investors are told that you can't get out of them. Even in the case of IPOs, when you do book builds, there is a lock-in period in which you can't really exit. So I think that also plays here. Also, if there are new companies and you are actually talking to dealers in doing a hedging transaction or borrowing based on the transaction, and then the dealer does an event or a transaction with the stock, there could be stock price implications. So stock could fluctuate. So sometimes with companies, even in an IPO with no trading history, stock price can have spikes. So what the brokers or the advisor would not recommend doing anything with that particular stock, because they don't have a clear trading history on the stock. So when you want to do any kind of hedging strategy or monetizing strategy or lending strategy, it's important for that stock to have trading history, so that it's not affected by market movements. Now, let's look at a topic that we've discussed in rather a lot of detail in behavioral finance, that is psychological considerations. So we discussed two kinds of biases. Okay, one was an emotional bias, and this includes all the biases. While the curriculum states a few biases, but it says the emotional biases include. That means that reading 7, 8 and 9 are fully applicable here. So whatever bias we have studied, whether it is overconfidence, whether it is familiarity, whether it is status quo, whether it is endowment, whether it is loyalty, you'll see new names as well, essentially multiples or derivations of the old names, but important to remember both. And what was the challenge with emotional biases? When you highlight to a client that you have this emotional bias, what is his first response? So he becomes defensive. He becomes defensive and tries to justify, and will tell you that in 1964 I bought a company, and because I sold it 40 years from now, now I'm standing here and I recall that because of that I will never buy this particular stock regardless of pricing. So that status quo or that anchor is very difficult for you to pull from that perspective. So if you meet that kind of client who has an emotional bias, there's very limited things that you can do with that particular client. Now, what about cognitive biases? We discussed that cognitive biases are driven by memory errors, analytical limitations, limited data, incorrect analysis, okay, myopic visions on how to analyze, and can they be corrected?
Yes.
Okay, so they can be corrected. So when you identify a cognitive error and you have a client or in the event, even if there's a portfolio manager and he makes this kind of error, what would be the natural reaction when you identify this kind of error? Okay, so he's receptive. Okay, and what did we discuss were the measures that you can potentially take to correct cognitive biases? Ask the right questions, that's number one. Provide more information. The third thing was document. Look at the thesis, investment research thesis that has gone into the stock. Take a look at that to see if you've made a mistake. Increase your sample. We discussed base rate neglect, sample size neglect. So we discussed conservatism, whereby we took too long to move on items that we were supposed to move quickly on. So we are lagging the market when we follow conservatism. We said confirmation was we only took things that were supporting our analysis, and we said this is the right one. Illusion of control falls perfectly into executives or employees or even traders who think they can drive markets. And then we discussed that markets are so complex that no matter how big you are in terms of being a trader or a market player, you can't be that big a market participant to drive markets. Markets are complex. We discussed availability in terms of, we discussed that there were 50 names, 20 were famous men, 30 were not very famous women, and people could only recall the names of the men because they were all actors, Hollywood actors. So I think that's also, we discussed recallability in that context as well. And then we discussed a more severe form of conservatism, which was anchoring and adjustment. So we discussed that while conservatism can lag the market, with anchoring you essentially park yourself on a price and you are not going to move. Okay? So there is a very, very good example in the curriculum. Okay, so this is the Baylor family. Mr. Baylor, P.S. Baylor was the former CEO of ABC Corp. This is a large public company, and he's been a CEO for a long time. So he's been a CEO for over about 2 decades. So during his tenure as a CEO, he was able to accumulate a substantial holding of this stock. And while he retired in 2010, he continued to serve on the board until his term expired by the end of 2011. Now this gentleman is 55 years old, he's healthy, and he has a life expectancy of 87 years. So he will go on to live for another 32 years according to the actuary. And we've all discussed that actuaries are incredibly accurate in terms of predicting how long we will live. And I think his longevity has to do with the fact that he's married to Brooke, who is also 55, and she's also healthy. So this is a very healthy situation that we're dealing with. Now Baylor currently owns a 3 million share position in ABC Corp. Now he has 3 million shares, and at the current market price, his portfolio is a whopping $60 million. Okay, that's $60 million. That's a lot of money. And the other 20%, this actually represents 80% of its entire portfolio. This stock holding is 80%. And the other 20% is very accurately, very sophisticatedly invested in high quality fixed income securities and a very diversified portfolio of equities. So at one hand, he's playing with fire, and on the other hand, he has a very safety-based strategy. Great. Interestingly, ABC Corp, and you will see many such examples, that this share price has continued to increase, There is a very healthy dividend yield, and this dividend continues to pay the living expenses for this family. So the important thing to consider is that 80% of the portfolio is actually in one company, one stock essentially, that is catering to a significant portion of the spending needs of these people. Okay? Now, the tax cost basis of this holding is close to zero. So the one thing that's clear is that this stock, which has gone up in price, has a zero cost base, so there's a tax event that's going to happen. And there is a tax liability that this $60 million portfolio, if sold, would trigger a liability of $9 million at a capital gains tax of 15%. So we're looking at a case of an individual who has concentrated holdings. He has 80% of his portfolio is in one stock. It's a good stock, is growing. That stock takes care of his expenses, and if he sells it today, he will incur a capital gains tax of $9 million. Now, while he was CEO, now the story talks about why he ended up having this concentrated portfolio, this big portfolio. Because when he was a CEO, he was required, and that's the key word, he was required by his employment contract and his company policy to maintain a large position in the stock. So looks like he didn't have a choice. So while occasional sales were permitted, but there was a behavioral angle to it that when you are selling your own company, you're frowned upon, nobody likes it. That means you don't have enough faith in your company. So I think based on that, since they were not very encouraging of selling your own company's shares, a lot of them actually ended up having a lot more shares. Also, the case study says that one of the reasons why they've actually imposed this policy on employees is that all employees can collectively ensure that there is no hostile takeover. So it gets more complex. Okay? Right. So, and also there's one more point to it, that this gentleman was an insider. So because he was an insider, there were rules that prohibited him from selling the stock. So now the country, and they haven't mentioned the country, let's assume it's a developed market. They have a long-term capital gains tax of 15%, which currently means $9 million. However, this tax is expected to increase at the start of the next year to 23%, which would mean that this 9 million capital gains tax will increase to about $14 million. So there is a $4.5–5 million jump immediately when the new legislation comes into play. And also they mention that in the event of a death, the basis would have a step up, so that the current market price would become the new basis for the stock. Okay? So the day that he dies, which is again a long time from today, the price of that day will become the new basis. So there is a tax benefit that they have mentioned, that there is actually a tax benefit on bequest. Great. Now let's come to the softer side of things. So while he is no longer associated with the company, they say that he is a big fan of ABC Corp. So he loves the company, he's been the CEO, he follows the company regularly. And it also says that because while he does not have any more insider privileged access to the company's numbers and strategy, he feels that he knows this company better than other investors. Alright? And Mrs. Baylor also has an emotional link to the company, that she remembers that they started when they were starting out, they had a negative net worth, and now they have skyrocketed as the ABC Corp's position went up. So they see The reason why they are both healthy is also got to do with the fact that ABC Corp has been their savior. Okay? And it has paid in the past a substantial portion of their living expenses. So this dividend is their bread and butter. So immediately the question now, let's look at an exam perspective. So this could be a potential case study, and what you would be asked is that once this gentleman is off the board, what should you do with this stock? Okay, first option would be do nothing, status quo. The other option would be do something, and in doing something he will have a number of options, and we'll have to pick the right options, and there will be only one right option. So the first thing that the examiner can ask you to do, and in this case has asked us to do, is to identify, and this is Sloan who's the advisor, so you will also be the advisor. So first have to identify primary investment objectives for the Baylor family's concentrated single asset position. So what is the primary investment objective? So the primary objective is first to reduce wealth concentration. 80% of his portfolio is with one company. He's retired. He doesn't have to hold it anymore. And they've retired. And we've discussed this in various sessions. And if you're retiring, that is not the time to buy the fancy sports car. Unless you can really afford it. So essentially, he has 80% locked in one asset. So he needs to unlock from that a particular asset. So the first statement to make is that they own 80% in concentrated holding in ABC Corp. And the first objective should be to reduce the concentration. And secondly, provide enough liquidity so that they could take care of their spending needs. And the third objective would be to ensure that this is done in the most tax efficient manner. Okay? Now the second question that relates to this particular case study is that the examiner will ask us to identify primary constraints that might impede the Baylor family from achieving their primary objectives. So what will stop them? There are, I think, two aspects that you could perhaps take a look at. The first aspect would be the behavioral aspect, but let's look at the first practical aspect of why they should do it or not do it. But let's talk about constraints. So the first constraint is they are incurring $9 million if they sell this. That's a reasonable constraint, I think. $9 million. Okay. However, if they sell it after 1st January the next year, they would incur close to $14 million. That's 13.8 in the curriculum, because of the anticipated increase in the tax rate. That would mean that while tax is a constraint, this tax will be substantially higher in future. So if you look at the trajectory, the tax is increasing. So if he sells it in subsequent years, there will be a very large tax impact. Now, another impediment or another constraint is that there is a step-up cost basis at time of death. That would mean that there will be, if there is no tax impact, once he dies and it passes on to Mrs. Bailey, who we hope will continue to be healthy, or their children, there will be no tax impact, tax event. But the problem is that he, according to the actuary, will die after 32 years. So if you look at the present value from that time, that will not be very substantial, because that time is a long time away. So if this event, according to the actuary, was happening in 2 years, he would never sell, because he would save $9 million or $14 million, because the tax basis will become the value at time of death. So there will be no tax. But because it's 32 years, You really can't take a view on that at this point in time. Okay? So it's clear that the diversification constraints are not valid. Now let's look at the third point. So on the basis of the information given, discuss what emotional and cognitive biases may affect decision making of Mr. and Mrs. Baylor. So let's talk about the emotional biases. What are the emotional biases? What's the first emotional bias that you see in this instance? There is familiarity. There is a sense of loyalty to the company. Is there overconfidence? I know this company better than anyone else. He is a big fan of the company, so he knows that. Okay, there is an illusion of knowledge, right? So, and what else? What else from a perspective of Mrs. Baylor, rather? This company is paying our expenses. Why change things? Status quo. So, the final point here is that they've actually created a new scenario whereby reading 7, 8, 9 will be tested. So this particular topic can actually bring in that behavioral finance flavor and actually can ask you to identify the cognitive and emotional biases in a particular scenario.